Okay, let's go ahead and go through the solution to the first of the Module 1 homework questions. On January 1st, 2018, big company acquired little company in a transaction to be accounted for as a merger. On the date of the acquisition, little company had the following information, and we need to record this acquisition under 4 independent scenarios. So first, we're going to assume that big company paid $600,000 in cash to acquire little. They also incurred $30,000 in legal fees accomplishing this acquisition. Now, the first thing to remember is that the historical cost or book value to little is completely and utterly irrelevant. Basically, big company is buying a bundle of used assets and assuming some liabilities, and when you buy a used asset, you're not concerned with its book value to the seller. What you're concerned with is the fair value of the asset that you acquired. So the first order of business is going to be to determine the amount of goodwill or bargain purchase inherent in this transaction. So we start with the fair value of the assets, simply adding up the fair value of all the assets from cash and receivables down to patents. Please note that the goodwill that Little had of $20,000 is not a separately identifiable asset that we can acquire. We subtract out the fair value of the liabilities, $210,000, and that gives us the fair value of the net assets, $570,000. We paid $600,000 in cash, resulting in goodwill of $30,000. So let's go ahead and record this. Again, we're going to go ahead and record the acquisition of all of these various assets. They're going to be recorded at fair value. We also record the assumption of the various liabilities, and the only thing that really bears mention here is that the bonds payable account itself is of course recorded at face value. The difference between the face value and the fair value is in this case a $10,000 discount. We record that $30,000 of goodwill that we computed, and we record the payment of $600,000. Next, we need to record the merger expenses, and again, incidental acquisition costs, legal fees, accounting fees, things of that nature, are expensed as incurred. This is a change, in fact, from the way we normally view the acquisition of an asset. Normally, we say when we acquire an asset, it is recorded at the fair value of everything surrendered to acquire the asset and to get it to its place of and condition for use. So, if we were simply buying a car, any acquisition costs associated with that acquisition would be added to the cost of the car. In the case of buying a business as a going concern, the incidental acquisition costs are expensed as incurred.